Most traders believe the market is their enemy. They stare at charts, they study indicators, they hunt for patterns, looking for certainty in a place where certainty doesn't exist. But the real battlefield of trading isn't on your screen, it's in your mind. Because the truth is, you don't lose money because the market is irrational. You lose money because you become irrational under pressure. Today, we're going to break down the trader's emotional battlefield, why psychology matters more than strategy, the emotional traps that destroy accounts, and real-world examples of how even experienced traders sabotage themselves by letting emotions take control. Why trading success isn't about charts alone. Let's start with a hard truth most traders don't want to hear. Charts don't execute trades. Indicators don't manage risk. Strategies don't control emotions. You do. You can give 10 traders the same setup, the same rules, the same account size, and you'll get 10 different results. Why? Because trading is not a technical problem, it's a psychological one. The market constantly puts you under stress. Money is on the line. Outcomes are uncertain. Losses feel personal. Wins feel validating. Your brain wasn't designed for this environment. From an evolutionary standpoint, your mind reacts to uncertainty and threat with fear and impulsive action. But trading rewards the opposite: patience, detachment, emotional neutrality, consistency. This is why traders with average strategies but strong emotional discipline outperform traders with brilliant strategies and poor self-control. The edge isn't knowing what will happen next, it's knowing how you'll respond no matter what happens next. The common emotional traps that destroy traders. Let's break down the emotional landmines that traders step on every day. 1. FOMO. Fear of missing out. FOMO is one of the most destructive emotions in trading. It sounds like, I can't miss this move. Everyone else is making money. I'll just jump in now. FOMO trades are almost always late, poorly planned, oversized, emotionally driven. Instead of following your rules, you chase price. Instead of waiting for confirmation, you act on anxiety. The result? You buy tops. You sell bottoms. You exit early when fear kicks in. Stoic reminder: you are not entitled to every opportunity. Missing a trade is not a failure. Breaking your discipline is. Revenge trading. Revenge trading happens after a loss. You feel wronged. You feel embarrassed. You feel the urge to get it back. So you increase position size, ignore setups, enter trades with no edge. At this point, you're no longer trading the market, you're trading your emotions. Revenge trading turns small, manageable losses into account-destroying drawdowns. The Stoics warned against this centuries ago. No man is free who is not master of himself. If a single loss can hijack your decision-making, the market owns you. Panic selling. Panic selling happens when fear overrides logic. Price moves against you, your unrealized loss grows, your heart rate spikes. Suddenly, you exit, not because your thesis is invalid, but because the discomfort is unbearable. Ironically, panic selling often happens right before the trade would have worked. This creates a painful cycle. You exit early, price reverses, regret sets in, confidence erodes. Over time, traders stop trusting their own plans. The market didn't break your strategy. Fear broke your execution. Overconfidence. Overconfidence is the silent killer. It usually follows a winning streak. You start thinking, I've figured it out. I don't need stops this time. I'll size up. It's a high probability trade. Overconfidence leads to excessive risk, sloppy execution, ignoring warning signs. The market has a way of humbling traders who confuse luck with skill. Stoicism teaches humility, not as weakness, but as protection against self-deception. Let's talk about reality. Some of the biggest trading blow-ups in history weren't caused by lack of knowledge, but by lack of emotional control.
Example 1. The experienced trader who overleveraged. An experienced trader has years of profitability. After a strong winning streak, they increase leverage. They break position sizing rules. They assume the market will behave. Then volatility spikes. One unexpected move wipes out months or even years of gains. The trader knew better, but emotion overrode discipline. Example 2. The retail trader during market crashes. During sharp market drops, many traders panic sell at the worst possible moment. They exit at maximum fear. They lock in losses. They watch the market recover without them. This isn't stupidity. It's human psychology under stress. But successful traders train themselves to act despite emotion, not because of it. Example 3. Social media-driven losses. A trader sees a stock trending online. Influencers are bullish. Screenshots of profits flood their feed. They abandon their system. They chase hype. They buy near the top. When momentum fades, they're left holding losses while the influencers move on to the next story. Stoicism teaches independence of thought. If your decisions depend on external noise, your results will too. The market is neutral. It doesn't care about your opinions, your hopes, or your fears. But if you don't master your emotional battlefield, it will expose every weakness you have. In the next part of this series, we'll dive deeper into Stoic principles traders can use daily, practical tools to stay calm, disciplined, and consistent no matter what the market does. Because in trading, the greatest edge isn't speed, leverage, or information. It's self-mastery.